Good morning, guys. And now the governments hold roundtables, and we've actually went and got ourselves an actual roundtable for this. And I just want to say hello to everybody. So Tom, Effie, Mel, thanks very much for coming in. Now, you're all Yellow Brick Road franchisees or branch owners. You run branches in various parts of town. I'll get you to introduce yourselves in a second. But we're putting this up on the various channels. It's important that consumers, the people you deal with every day for many, many years, and you're all very successful at what you do, to understand where the trends are going in relation to borrowing money at the moment. We're not here to talk about buying property. We're here about borrowing money. And, we talk about all the various levels of borrowing money, whether it's asset finance, consumer, commercial finance, whether it's first home buyers, whether it's investors, owner occupiers. We're going to talk about all that stuff. But today is about putting down on the various channels that we're going to push this out to some of the tricks, traps, myths, stuff that you see day to day that people stuff up when they walk into your office for a home loan or for an investment loan or for a commercial loan or for a loan for a tractor or whatever the hell it is. What are the things that they either come in unprepared, underprepared, overprepared, say too much, or they're just not ready at all. They haven't got a clue. They're clueless. So I'm going to start with you, Effie. Maybe you can introduce yourself and where your branch is and how long you've been around with us. And I know you're an award winner in our organisation for many, many years. You all are. But where are you located and what's your deal?
Yeah, I'm Effie Nicol and I'm located at Yellow Brick Road at Earlwood, and I've been at Yellow Brick Road since 2011.
So Mel, what's your deal? Where are you?
So Mel Falanga from Yellow Brick Road in Leppington, the beautiful southwest Sydney. Bit of a growth corridor out there, a lot happening, new airport. Geographically, it's quite sparse, a lot of green space that's getting developed, and some great opportunities for businesses, homeowners, everyone getting into the market and any type of real estate.
And Mel, along with his business partner, is one of our biggest volume branches in just about everything, commercial and residential. And Tom, where are you?
Sure. Tom Haggie. I'm based in Yellow Brick Road, North Sydney. We set up the franchise in 2016, so going on almost a decade with the group. We do a lot of work with, obviously we're in a CBD in North Sydney, so we deal with all different types of clientele, from self-employed, investors, home buyers, the whole box and dice.
Now Yellow Brick Road covers Australia, but obviously today we just got Sydney people. The reason why we've sort of picked you guys is because Mel's out west, so he gets one type of client profile. Doesn't mean he only gets those clients, but he does see a lot more Western Sydney profile clients. Effie's inner west, I guess, is probably in southwest, I guess, is probably the better description. So you get to see those types of clients. And you, Tom, you're probably seen more wealthy people, mind you. There's a lot of wealthy people out. A lot of people, real wealthy people out your way. So, and by the way, this is Sydney, so every bit of real estate in Sydney is expensive. But you're covering off a different sort of demographic, social demographic, and you might have some thoughts around these sort of types of clients, the sorts of things you talk to every single day. But I'm going to start off with you, Effie. We have a big problem in Australia, and particularly for first home buyers. Can you sort of share some insights around, I'm a first home buyer, I come to see you at Earlwood, you're renowned for your good service, but what are some of the things that you're seeing in relation to first home buyers and some of the things that first home buyers should be thinking about maybe before they even start looking to buy real estate?
Yeah, they come in every day, to be honest with you, and they're unprepared. So they're not planning what they're doing. So they haven't even looked at their budget. So they're not sure whether they can afford a home or not. So we need to really start from the basics and help them save. So I talk them through their budget, what they're spending. I look at their borrowing capacity. And then I talk them through what goals they want to achieve in the time frame. So it's a bit of preparation. And I also talk them through what documentation we require so they can be in a position to get a pre-approval and buy. And the biggest problem that I've been seeing lately is first-time buyers that do have a deposit generally can't borrow what they want to buy, which area they want to buy. So inner west, for example, the property, the units are going for 800,000. But when I look at their borrowing capacity, the problem is they can only borrow 520,000. And this is where the gap is. So what lately I have experienced is on the weekend I had a client that wanted to buy property for 700,000, but the parents participated in actually helping them with a deposit because she really wanted this home. So I can only lend her 520, but the property's 700. So there's a big gap there. So we've got to be realistic for what they can afford.
I want to come back to
Yeah.
so parents actually lending you money and or parental guarantees. I want to talk about that in a second, and you guys can chime in here too because this probably covers all your areas. But I think we should actually talk about the importance of a pre-approval. So I was talking to someone the other day, and this individual was saying, "Oh, I'm thinking about buying my first investment property. It's an investment property." And I travelled to the Central Coast with my friend, and the two of them, they're looking at, what's for sale up there because they can't afford Sydney. They're looking around Gosford area. And I said to this individual, well, have you saved a deposit? And they said, oh, yeah, we've got a $150,000 deposit. And I said, well, how are you looking at what price you can buy your property for? Like if you've got a $150,000 deposit, how do you know how much you can spend? Mm-hmm. And then I said, it was a her, and I said to her, like you and your bloke, maybe you should come in and get a pre-approval. So at least with your 150 plus the pre-approval, you know how much you can spend. Otherwise you're wasting your bloody time. And then she was actually said to me, oh, it's too early. And I thought, how can it be too early? Actually, it's never too early to waste your time. Maybe you're happy to waste your time. But what you guys must be seeing this crap all the time. People underprepared. This is what I mean by underprepared. Or just not knowing the deal. And we, 30% of our applications that we approve are actually pre-approvals at Yellow Brick Road in our group. And we do $2.5 billion a month for the whole group. So that's a lot of, that's 600 million or more, it's nearly 700 million worth of pre-approvals every single month. So maybe you guys can open this up a little bit. What are you seeing, Tom? What are you seeing, Mel? What are you seeing, Effie? Why are people too scared about getting a pre-approval?
I think that's a really good point, Mark. I think when we initially sit down with the customer, you've got to understand what it is they're looking to achieve with the purchase. So, for example, if they're buying an investment property, if you don't know what the purchase price is, how do you know how you're going to structure the transaction? For example, if you don't have a 20% deposit, which is not uncommon with investors because they often like to hold some of their capital in case they want to go and buy another property down the track. So they use tools such as lender's mortgage insurance to assist them in getting into a property sooner without having to save the 20%.
So in other words, they borrow 10%, but they pay a premium effectively on their interest rate for the other 90% because, that's what you call lender's mortgage insurance.
Correct.
The lender will lend them more money.
Correct.
But there's a bit more risk involved. So the lender sort of jacks the rate up by hitting him with a fee.
And with that as well, you need to understand different lenders have different policy or appetite based on lenders more or higher risk loans. So if the lender is lending you 90% of the value of the property, they might be a little bit more restrictive on things like where you're generating your income from, how long have you been in your job, things like that. So it's important to understand that if you are going to purchase in that sort of parameters, which lender is going to be suitable for you. And the pre-approval process is critical to doing that.
So they come into, say, one of our branches. They can go any broker. I mean, in the country, it doesn't really matter. Because and there's a danger by the way, if you don't go and see a broker, you go and see the bank direct. Because if you make your application and they reject you for some reason, you're in that goes up on your file. So seeing a broker, actually, you guys know all the various changes, literally changing every single week in terms of appetite for lending by banks and non-banks for that matter. Borrowers should understand that going to a broker opens up their chances better of getting the appropriate loan for their circumstances. But if I could just go back a little bit to the pre-approval process, why is it why is it an important plank in the strategy about buying real estate? Why is it so important to get an understanding of what you can borrow?
Because you might go to auction and you need to know the maximum you can bid for, because if you overbid, you might be short to complete your transaction. So you really need to
Then you're in trouble.
That's right. And it's very common. Like on the weekend, I had an incident where they've bidded above the maximum purchase price that I pre-approved. So now we're going to have an issue that we need to mitigate with the lender to get them the extra dollars they need to complete the transaction.
Do you see that very often? Like people get you sort of look at how much you can lend to them, and they've got maybe 200 grand, whatever. They got a deposit, hard earned, saved, and they go and get a bit excited at the auction and borrow too much.
I call it emotional buying. So they get excited and they bid higher than they
What's
should.
the market price though? They've got to pay the price.
Yeah.
I think auctions are dangerous sometimes. Ego sort of comes in. Did anyone watch the block last night? That was a classic example of what can happen at auctions. You get some egos, running around the room, and you can go pay over. But back to your question, Mark, I think around pre-approvals and the importance of them. It's not just around getting a pre-approval, I don't think. Sometimes we need to assist clients and educate them around spending habits, right? Another big thing.
What does that mean?
So for a young couple that are, let's say they're renting at the moment and, they're paying $700 a week in rent. They don't have a mortgage, but they want to get their first home, and mortgage repayments are going to be $1,200 a week, right? So they're going to essentially have to come up with another $500 a week for their mortgage, and they might be able to afford it. But, they might live a lifestyle at the moment while they're renting, while they've got that $500 a week of disposable income. Additional income. They might be doing the Uber Eats, and they might be, doing a sports bet here and there and all that type of stuff. So I think, firstly, it doesn't cost anything for anyone to go and see a broker. It doesn't cost a cent.
Yeah,
right?
There's no fee.
There's no fee, right? So they can come and...
Well, some brokers do, shifty brokers charge a fee.
Some do.
But you guys don't.
No, we don't. So the information and the support is free from our perspective. So I would always encourage people to early engagement is always the best option when you're thinking about, getting into that property market, making that next step, whether it's investing, first home buyers, whatever it is. But there's some things, and what we understand as brokers is obviously we deal with 50 different lenders. We understand each different lender's appetite and policies, and there are things that can weaken an application, such as sports bets and those types of transactions when the lenders review bank statements, right? So we can help educate clients prior to going for these loan applications to say, okay, essentially you can afford it, right? But we need to make sure that we start changing some of our habits prior to actually going for an application.
In other words, improve your chances.
Improve your chances, absolutely, and also prepare them for you're going to be spending an extra $500 a week if you go and get your own property. So it's also educating them around that, because I think it's the mentality of a generation that I'm seeing out my way is that they want things now, right? So they rack up credit card debts and all that type of stuff. So and that would be the biggest killer of deals that I'm seeing out my way, and I'm not sure with Tom and Effie, but in the younger generation, the killer of deals that we're seeing is 18, 19 years old, they go get a personal loan for 30, 40, 50 grand for a car, and then they've got a credit card. And then they go on a holiday and they rack up the credit card and all that type of stuff, and then they say, okay, now I want to get a home loan, and it just doesn't service because they've got all this other consumer debt.
It doesn't meet the servicing requirements.
Correct. It doesn't meet the servicing requirements because of all this other consumer debt that they've got.
Okay, so I come into you and I'm a younger person and I've got I'm paying $700 a week rent, and I've got I've been living the life, but I've decided I want to change my ways, and I accept that I know that I'm going to have to now spend $1,200 a month, or $700 a month I was spending on rent. I now have to spend $1,200 a month, whatever it is, whatever the numbers are, and I know that I'm going to have to be much more frugal in the way I live my life, but I'm prepared to do it. Okay. Yep. But I go and see you, Mel, and I sit down with you and at Leppington, and you say to me, mate, I'm just going through your bank statements, and I notice that you're spending the $500 a week extra month, whatever it is that you've got to spend on your new home loan, that you've done a calculation on through one of the calculation sites or one of the calculation formulas that is on every site. You might not get that loan approved right now, because you're actually spending all the money. It's, in other words, you do not satisfy the servicing requirements of most of the major lenders, most of the lenders, pretty much every lender. How long does it take? So I now know, shit, I better not go and have a look for a property now because I'm not going to get a loan. How long does it take to cure that spending? So I'm sitting in front of you saying, now, Mark, for the next period, stop spending money on Uber Eats or whatever it is you're doing, movie theatres or whatever you're doing, concerts, blah, blah, blah. How long does it take me to cure that behaviour, so-called, that appears on my file?
So generally, in most cases, about three months, right?
Okay.
So banks generally want to see 3 months worth of
Good behaviour.
They want to see 3 months worth of transaction history on your everyday accounts, right? They want to see your salary credits go in there. They want to see your spending habits. Now, one thing that a lot of people may not know is lending in Australia is governed and regulated by, calculated on a thing called HEM, Household Expenditure Measure. Right. Now,
It's a formula.
It's a formula.
Yeah.
Now, there's an algorithm that sits behind this, right? So a 27-year-old person that lives in, I'm going to say Leppington, that's where I'm from. So it's postcode driven, it's age driven, it's income driven. So there's lots of different
Independent driven.
Independent driven, right? So are you single, married, kids, no kids? Do you earn 50,000 or do you earn 200,000? So this household expenditure measure changes for every different individual, right? So Mark, me and you could go for the same house. We live in the same area.
Have the same deposit.
You earn 200 grand a year and I earn 100 grand a year. Your HEM is going to be different to my HEM. So the expenses that the bank will say, okay, Mark needs $5,000 a month to live, where Mel needs $4,000 a month to live.
Because they make an assumption that Mark spends more money
Because you earn more.
per month, because maybe I got 10 kids and you've got none, or I've got a dependent at home and you've got none.
Correct.
They allocate to me expenses, even if I don't spend it.
Yep.
They allocate to me expenses.
Correct.
On the assumption that that's how my demographic sits.
Absolutely. So, it's data collected across, lots of different people and different income levels, different dependent levels, postcode driven, all that type of stuff. And so this is where we're saying early engagement with a broker to understand what your spending habits and all that type of stuff. I think that's really important.
That will then inform you, and then you can inform the borrower, the buyer, borrower, how much they can buy based on the HEM assumptions that relate to that particular individual. So a good example maybe is that I want to buy in Leppington. I got $200,000 salary and I got $200,000 deposit. But my kids go to school in a fancy school in the east suburbs, and I got 3. Mel, on the other hand, is also earning exactly the same income. He's on $200,000, and Mel has no children. Or Mel's children go to the state school, the government school, free in Leppington. Mel's also got a $200,000 deposit. I think what you're saying is that the HEM regulations for lenders that they have to adhere to means that Mel can borrow more money. Is that right?
My expenses are less. So
because the assumed expenses are less.
Absolutely.
What happens if my mum is paying for my kids' schooling?
That's a really good point, Mark.
Can you go back to the lender and say, no, but Mark's not actually spending that money?
Yeah, so different lenders, and when we're going through this process, it's about understanding. So with the HEM measure, private school fees actually add on top of that. And also with HEM, there's a common misconception out there that if I declare really low living expenses, well, the bank's going to lend me more money, which is it's actually the polar opposite. If you declare really low living expenses, the bank's going to say to you, okay, well, show us everything so we can see how you're living such a frugal lifestyle. So it actually can, in some instances, hurt your application by having to provide more than absolutely necessary to.
And just on that, Tom, when you say hurt, I think we need to explain this to the audience.
Sure.
Hurt means you borrow less.
Correct.
Or maybe not borrow at all, but definitely borrow less.
And with the school fees, having a broker who actually understands lenders' policy around, if you can demonstrate that you have savings to cover the school fees, they might exclude that from your living expenses calculation, or as you say, if you're getting a gift from grandparents, etc. So there are lenders that will look at things a little bit more
Which you guys know about.
sensibly. Correct.
Yeah.
Because if, as you say, in that scenario where you've got 3 kids at, a prestige or private school or what have you, compared to the, the state school scenario, the borrowing capacity will be, drilled into the ground, because they're going to have to show, $60,000 of after-tax income to pay these school fees. So you really very quickly, you go from being able to borrow what you need to not being able to, borrow what you need.
So just on HEM versus actual. So HEM is about a presumption about how much you're going to spend based on a whole lot of stuff, as you mentioned earlier, dependence, where you live, postcode,
Income.
your wages.
Yep. So your income, your postcode, dependence,
Age is age.
age. Yep.
Age is
Age is also in there. Yeah.
So the older you are, the worse.
They probably assume you stay home more.
Yeah,
Don't go out to the pub.
They make some assumptions around your
It
age.
could, and it could be things around entertainment expenses, right?
Yeah.
So I think a young 22-year-old couple may dine out or go to the local pub for a beer every Friday night after work, whereas
The boring old bastards, they stay home.
right.
So when does actual take over presumed? So do they actually then say, oh, by the way, show me your actual expenses now? So you've done the calculation based on the HEM assumptions.
Well, we take the higher of what's
higher
of the higher.
declared
Well,
versus. So
we
HEM
or
is
the
what-
bank does?
Well, we as brokers, it's part of our due diligence to make sure that we got an accurate picture of what they are spending.
Yeah.
And it's quite important to note as well with, particularly first home buyers and the like, often what they are spending, without a big mortgage, and what their behavior will change. And it's about our job as well to show them, okay, and educate them that, okay. And I always say there's a difference between what the bank will give you versus what you actually want to spend in terms of what lifestyle you want to have without, you don't live on baked beans and jam sandwiches because you're having to pay off this, massive loan. It's about trying to balance balance what you can afford and going through that journey with them. So it starts off, as Effie mentioned, with having that budget discussion and then working out, okay, well, is it realistic what you're thinking, or is there, do you need to adjust your expectations as to what you're going to be able to afford?
Okay, so but if you it seems a little bit unfair, but it doesn't matter if this is the case. Tom said they take the higher of the assumed expenses on the HEM versus the higher of that, or what you actually spend. So if for some reason the HEM assumptions are nowhere near what you spent, you were really frugal, like you don't go out anywhere, you've been staying home every night of the week, you intend to, and you've saved up your deposit by doing that, do they sort of ignore that? Do they ignore your actual expenses because they'll say the HEM is higher, we'll take the higher of?
Yeah. What normally happens if you don't declare above HEM, they'll scrutinise their bank statements and add everything up and say, well, you haven't declared the right amount. You spend more than you do.
But what happens if you don't spend more than HEM? So I'm actually am frugal. I'm very good. I don't spend. What do you do then? What does a broker do then in relation to that particular application?
Yeah, they're always going to take the higher HEM.
They're always going to take the higher off.
Because
Can
otherwise...
you read the bank and say, listen, that's crazy because you've assumed that, Mark lives in these suburbs, and on the example I gave you, and his kids are going to a private school, but his mother, the grandmother of the kids, is paying for the kids. So don't take that assumption out because Mark's actually expensive. If you have a look at his bank card or his credit card or his check account, whatever it is, you can see it's not being paid. Can you actually go back to the bank and sort of arm wrestle a little bit?
You're fighting a losing fight, I think.
Really?
Yeah.
Wow.
Look, there's lots of different things.
There's some lenders that may consider it, as in if you had presented it in that way. However, whether or not there'd be any benefit to you in terms of them offering you a higher borrowing capacity. Oh, that's great. Thanks for clarifying that. But we're still going to lend you.
They don't care.
I think I think we just look. The banks, they're not always so rigid either, right? And this is where again it takes people like Tom and Effie and myself to support clients through this process, because there can be legitimate circumstances that, mum and dad are paying for the kids' education because that's what they want to do for them.
Yeah.
Right? Now,
But do you need to get a letter from the parents?
Well, this is the thing, right? So this is where we say to the bank, okay, look, this is the actual situation. What can we do, right, to prove that to you?
Yeah.
It may be the form of a stat dec. It may be
from the parents or both.
From both,
yeah.
right? It could be from the grandparents and the parents, right?
Yeah.
It also could be, and I don't know this, and it's never happened to me, but my thought process is, how do I mitigate this, right? So it could also be, let me get grandmums and granddads' bank statement to say they've got enough money. The kids are in school for the next 4 years and it's 20 grand a year. Let's show that there's money there to actually support that, so it can be excluded. So, look, will that be accepted or used as an exception from the bank? Don't know. But this is where we will fight for the clients to try and, really portray what the actual situation is.
Okay, can I just stop you there for a second then? Because what's interesting about that, and I'd like to hear what you guys think about this, is that you're dealing with different banks all the time, and they get to know you. They know who you are. And whereas if I'm not going through a broker, I just put my application in, and I'm not dealing with a bank manager. I'm dealing with an online application usually, and I don't get to talk to anyone because there's no one to call. And whereas you guys as brokers, and all brokers is, but you deal with people in the banks. You know them. You know people in the banks. We've been talking about today with people that are on a salary or wage, and they get paid every week or month or whatever it is, fortnight by their employer, and there's a nice clean sort of, you can look on the bank statement, you can see where the money's coming in every month, and you can see what their expenses are because they spend money on these, all the various things with living expenses. And we've talked about the HEM, the assumptions and presumptions around what you will spend, and you mentioned that generally speaking, lenders take the higher of make an assumption as that your expenses is the higher of actual versus HEM, and we got that. And everyone's HEM is different based on a whole lot of other criteria. And some genius and somewhere or other has worked out what the HEM should be. I guess it's ABS or something like that. They probably got no idea, but anyway, it doesn't matter. We're stuck with that. What about, and you mentioned it about a moment ago, Tom, that there are lots of people out there, particularly professional people who have structures. Their account says, look, we don't want you to get personally sued for whatever you're doing, so let's set you up in a company or a trust, and all the income you earn from the work you're doing, you might be an engineer, you might be a dentist, or whatever you're doing, comes into that entity, and that entity might pay you a small wage, and then at the end of the year, whatever's left over, you get a distribution, either a dividend or you get, maybe it doesn't pay a dividend, but it's sitting in the entity. But that individual gets married and he or she decides that it's time to buy a house. But they've been paying themselves basically nothing, but the money's all sitting in the entity.
Yeah.
And they've got the deposit in the entity. They decide they're going to buy the house in their own name because they want to get capital gains tax relief. They don't want to pay tax on this and they want to live in it. It could be investment. Let's say they want to live in it. How does all this HEM stuff work now? And how does it all work now? Now what happens is we're calling this person a self-employed person, but they're sort of self-employed. They're really employed by their own company, but whatever. It's complicated. But are those people being penalised, or do they get penalised because they're not your normal run-of-the-mill? And I don't mean anyone who earns a wage is run-of-the-mill, but you know what I mean. How do you address that?
Yeah, it's a good question. So in terms of the HEM or on its own, it's still calculated in a similar way. So based on for example, when we're looking at a self-employed applicant, depending on what they've paid themselves in sort of director's wages and then how their profit is treated, whether it's retained within the business or if it's paid as a dividend, either way, it's still, the bank will look at that and say, well, for example, if it's retained profit, you can take that out. So you could pay yourself that if you choose to. You've chosen to potentially retain it in the business, but for all intents and purposes, they will calculate it as if you had taken it out. So with regards to HEM, it's treated very similar to if you are PAYG or on wages.
So it's part of your income.
It's part of your income, correct.
But they don't discriminate against you because you've got this structure.
No, they don't. No, I mean, I guess the one discrimination you could say is that some lenders will insist on you showing them 2 years of full financial statements and tax returns, which, when you think about it, compared to a PAYG worker, if it's after September of a financial year, you just have to show them one pay slip, and assuming you've been in the role for a minimal amount of time. So you could argue, well, if someone's self-employed, why should they have to show 2 full financial years versus someone who's on PAYG?
But they do anyway.
But they do, yeah, correct. So, yeah, some lenders will. I don't know if they're assessed differently, basically. Yeah.
So, like, anybody can help me, AD, because it sounds like it's complicated.
I love self-employed people. We're all self-employed, like Tom said before, and self-employed people and their accountants, do certain things to minimise tax.
Well, but they also try to protect themselves from creditors. There's just sensible strategies that you should have if you're self-employed.
Absolutely. And there can be a web of of companies until the income might be generated up here, and then it goes through a trading company, and then it goes distributed to a family trust, and then it goes to the beneficiaries of the trust and all that type of stuff. So there's lots of different structures that people do for certain reasons, like you said, asset protection and tax minimization, offsets. You might have husband and wife, and someone's got a lower salary, so they pay, they top up from the company, all that type of stuff, right? But there's also other ways for people that aren't paying themselves as a personal income. They retain that money or that turnover in the income in their companies. There's other ways that we can lend money, even if they haven't distributed it to themselves as an income. And, I think a lot of people heard it. And I think for the people that are self-employed, they would have heard of alt, doc, low doc type lenders out there. Some people.
These are usually non-bank lenders.
Non-bank lenders.
But they're lenders nonetheless.
And there's definitely a place for these lenders in the market, and I absolutely love them because they are helping. They're helping the people the small business owners that prop this country up, and I think that's super important. So just as a moral thing in itself, for me, I love these non-bank lenders that are supporting self-employed people to still be able to borrow money and get into the housing market or the investment market, whatever it is, commercial property. And not be disadvantaged because of these structures that they've got in place.
And is the reason for that? Because these non-bank lenders exist is because the mainstream banks prefer to play with mainstream borrowers, people who are earning a wage, because they already control the market. They don't have to go in any further down the credit line. Well, it's not really bad. It's not less credit, by the way. The credit's just as good, but it's less traceable credit. It's harder to sort of work out how good the credit is of these individuals because it's all being sitting in a company.
Yep.
Is the reason why the banks, generally speaking, don't get in that territory is because they've got enough business as it is. What do you think the reason is?
I think it's a combination of things. I think, there's a lot of legislation and, responsible lending regulations that sit, in the major bank space. They have to adhere to ASIC and APRA's, minimum requirements of showing, that they're doing their due diligence as far as assessing people's incomes. So the way I think the non-bank lenders get around this income verification piece is, that there's a company sitting behind it which is unregulated. Responsible lending doesn't fall into company borrowings and all that type of stuff. So there's it's a little bit different in that respect as far as lending.
But the non-bank lenders at the same time aren't lending sort of 90+%. They're usually it's more like an asset lend. So they're sort of saying, well, you're only borrowing 80% or 75%. If anything goes wrong, their risk is covered by the fact that the value of the properties
Yeah.
They just want to make sure they get their money back.
Yeah, they want to make sure they get
And
they
if you,
charge
by the way,
us
if you don't
anyway.
pay the interest or you don't make the repayments, they'll do exactly what a bank does.
what a bank will do.
They'll sell your property.
Yeah.
But they take the view that the risk is not that great because you bought it for $1 million. We only lent you $750. We know we can
fire
sell.
sale, we're
We,
gonna
and
get
we know we can sell it.
And and look, I think statistically, I believe from what I've read on certain forums and delinquency rates are actually far less
Yeah.
in that low doc self-employed space than it is in the full doc space. One thing that I've learned over my 20 odd years in lending is a self-employed person somehow always pay their bills. With someone that earns a salary, like you might earn $1,000 a week, and that's all you get. That's what you got to work with. And then if you lose your job, your income's gone.
You go on your cactus.
Whereas with self-employed people, I think they probably have more options. They might say, look, I'm going to start working on the weekends. And it might be a brickie or a plumber, and they're like, okay, well, I'm not having Sunday off anymore, or Saturday and Sunday. I'm going to go work, every Saturday and make an extra $500 to meet their commitments. So they've got a little bit more of that flexibility. So in turn, their delinquency rates, as far as bad debt.
And what you mean by delinquency rates, you mean across the whole universe of people who do these sorts of transactions. Delinquency means people who don't meet their obligations on a monthly basis.
Correct.
So against a whole universe of people, the delinquency rate, that's what you mean by delinquency rates, when people go into arrears or they stop making payments.
Yeah, missed payments, all that type of stuff. Yeah,
late payments, missed payments, no payments.
Yeah,
they all fit into this category called delinquency.
Yeah, absolutely.
So that's that's certainly our experience at Yellow Brick Road Group. That aligns with what you're saying. It seems like self-employed are better at, for some reason, whatever the reason is, and it's not honour or morality or anything. They just seem to be better at finding money from somewhere to make sure they make the payments.
Yeah, I think they've got the ability to, right? Like, if I was working, I worked for Westpac Bank for 15 years. If I was running short one week, I couldn't ring up Westpac Bank or my manager and say, "Hey, mate, I'm going to come and work on Saturday. Can you give me an extra couple of $100?"
Or you're not going to send it. You can't send an extra invoice out.
That's right. Do you know what I mean? It is what it is. Whereas, like I said, self-employed people, I think they're just a little bit more resilient, and they have some more options. So, like I said, they might do, instead of knocking off at 5 o'clock in the arvo, they might do an extra job and, do another job and finish at 7. Work the Saturday, work the Sunday, whatever it is. They've got that option to make more money.
And a good example of that, it's funny you should say that, Mel, because I remember quite a few years ago, not that, 3-4 years ago, about 3, during the COVID period, I was talking to a very high-level banker, no longer there, he's retired, at one of the major banks. And he said this to me. He said, my daughter works at the bank, and she just got married, and her husband's an electrician, works for himself. Her and her husband want to borrow some money. He said, but the bank was only interested in looking at what she earned and not what he earned, yet he earned 5 times what she earned. And he said, from his point of view, and this guy's a really senior banker, he said from his point of view, the husband is much better credit than the wife. And I think he was an electrician. And you're right, because an electrician, if you want to work your ass off, for example, and you just need a few extra, you just take a few extra jobs. Like tradies are in huge demand in this country.
Yep.
And you send a few extra invoices, and
There's
you would expect to get paid, sort of thing.
Yep.
Which is probably the reason why these individuals tend to do better or have less delinquencies. So when you're 3 of you, it's again, it's an important reason to go to a broker, in my view. And I'm not just here to tell people to go to brokers, but if you're a self-employed person, it's very difficult to borrow money. Just going to your local bank, you might run into trouble. So what are you experiencing? You're seeing lots of at Leppington Way, you're seeing lots of self-employed people?
Yeah, I think geographically out there, like I mentioned earlier, we've got a lot of developments happening in that southwest
Property developments,
growth corridor, and lots of new estates. So there's lots of tradies out there, right? Naturally, there's lots of tradies that live out there, work out there. So we're seeing a lot of these self-employed guys that are coming in with these challenges, these servicing challenges, where they're not meeting the minimums with the major banks. Some of them have gone to their major bank, and most of the time, they're getting referred over to us because we've helped one of their tradie mates, and got some stuff over the line. Mate, I just did one now for a guy who does garage floors, right? Epoxy garage floors.
So he coats them.
Right? I never bloody thought of this. If I wasn't in finance, I'd go and do garage floors. But mate, just refinanced $5 million worth of his properties.
Wow.
Right? Young bloke, early 30s. He's got like 7 investment properties. He does epoxy flooring for garages.
And you found him a lender.
Yep, I found him a lender.
Mm.
Right. And that was someone that he was referred to me from another tradie. So there's lots of money that these tradies make that doesn't always reflect in their financials because of whether it be the structure or retained profits in companies and undistributed dividends or whatever it is. And so this is where we've got options.
Effie, are you seeing these types of people?
Yeah, I have heaps of self-employed, and I use the alternative method by using their BAS statements and going to lenders that actually work through the policy of showing, deposit. They're paying themselves a salary through their bank account, or I use their BAS statements, and it works for me.
So what does a BAS statement do for
Yeah,
you?
well, it just shows their earnings for the 4 quarters. So they'll use that.
But you
as
talking about
income.
traditional lenders, or are you talking about
No,
the
no.
non-bank lenders?
I go to non-bank lenders, and if it fits within a lending policy, like for example, I had a lawyer that was previously PAYG, and now they're self-employed. They haven't done the tax return yet because obviously it hasn't been approved.
No tax return.
No tax return. So what I did is I could prove that the deposits were going into the bank account, and I went back to the lender and I mitigated the financial stability and showed the trend that was occurring the last 6 months, and I actually got the approval for them to borrow the money. Plus I also got lender's mortgage insurance waived. So it's a case by case. You need to mitigate and show them the reasons behind why you should do it. And there was a very reasonable, I had the proof that the deposits were there, and she was earning more money than what she was earning as PAYG. But if I had gone to another lender, they might have asked for, tax returns for the year and wouldn't have given it to her. But
and so I think what you're saying too, Effie, is that as a broker, you can select who's the most appropriate person for that individual's credit profile.
If they went into a bank, they probably would have got knocked back. No one even bothered to actually sit down and analyse the situation. I actually got all the supporting documents through the employer and the contracts, and I showed every single piece of evidence, and I mitigated the history around their serviceability on their previous loans, and I could demonstrate that this is feasible, and they actually approved it.
Are we talking about big money?
We're talking about a couple of mil. Yeah.
Okay, very good. Tom, you seen them?
Yeah, we see a lot of self-employed customers in our branch, be it tradies are a great example, and often they work in similar circles too. So you'll do a loan for one, and they'll go, "Oh, don't speak to your bank, go see him." And all different types of structures, be it sole traders, companies. As I mentioned, I do a lot with medicos who often, once they complete their training and become specialists, they move from being PAYG to being commonly a sole trader structure for them. So again, it's about understanding, well, what lender suits them at that point in time, because often with doctors too, when they've spent so long doing their training, they come out and they're like, right, I want to borrow some money, I want to buy that nice house. Their income starts to really ratchet up. So it's about finding a lender that will assess them at that point in time to do the transaction.
So Tom, those particular type of borrowers, and those particular type of lenders, like you mentioned ANZ, who like to lend to, let's call them medicos, for example, or people in the medical profession, do they look at the structure and they're happy to lend to them if they've got a trust or a company or something like that? Or they're only interested if they're earning it in their own name?
No, they're happy to. Commonly in medicos, it's sole trader income, so it's on their tax return. So they'll see that. So they're happy with that. generally where ANZ are quite good in that space is they will take a combination of, for particular industries, they're a bit more flexible. They'll say, okay, like if you mentioned two BAS statements, so they'll say, okay, they know this type of doctor and what their earning potential is. And they'll say, okay, if you can show two BAS statements, and we'll project out the income on the basis of that. So you're almost getting an alt doc style product with a major bank because they understand intimately how that type of doctor receives their income and what their probably book shows them that they're obviously very, very good clients because they start to earn, pretty good incomes and start to borrow lots of money, and the banks love them. So.
Good on ANZ, but there are also non-banks that you guys use as well. But ANZ is sort of a bit of a leader in this area. But I have seen periods where Westpac was doing the same thing for a long time.
With that alt doc piece, Mark, just where that's really handy is if a client hasn't got their financial arrangements up to date, returns and things, so that they can use an alternative way of assessing their income
or proving their income.
Yeah, sorry, the customer proving their income. So
because I think it was just so Mel used the word alt doc. We should explain what that means. So generally speaking, there are most lenders that have a standard set of documents that they need to see: tax returns. If they want to verify your income and your expenses, so there's standard stuff. Then there's some people who don't have standard stuff. They might not have lodged a tax return because they might have just gone into becoming a plumber, been too bloody busy to lodge a tax return, whatever. It's not a crime. And there are lenders who say, well, we're looking for an alternative set of documents. Yep. They're not a less valuable client. In fact, they're very valuable clients. They're not more likely to default. In fact, they're probably less likely to default. But these individuals have to only going to borrow from those lenders who have what they call alt doc loan products, alternative set of document loan products. That's what we're talking about here. And now I just want to finish off on this. We didn't really get into commercial lending, but maybe that's another time for us, Mel. But this sort of same principles really apply for commercial lending anyway, generally speaking. I mean, you guys know who your lenders are. You know what the client's commercial circumstances are. You know who will lend on what basis. Slightly different to a residential borrower, but nonetheless, basically you're brokers and you know the rules. And lending is a rules-based game. It's about the rules. And consumers will never know the rules because the rules, you might know them this week, but they'll change next week. And by the way, what the rules are for one lender is different to another lender. We just established that between alternative document lenders and standard document lenders. And it's moving, and there's like 50 lenders. And so they're all changing. And new lenders come and go. Like there's someone lending, the next year later, they're not lending anymore. And a lender who's been there for 40 years decides we don't want to lend in Chatswood anymore because we don't really lend, or we don't lend in that building because we've already got too many loans in that particular block of units. That's called concentrated risk, which is what brokers do. You're navigating all the time, and that's your job. You have these duties under legislation to act in the best interest of the client. That's actually a legal obligation, and the best interest of the client is quite a broad thing, but it means just make sure that the client gets the best loan optimized for their circumstances, both in terms of time, when they need to settle, whether they're getting a pre-approval, interest rates, and interest rates it's not always the cheapest rate that matters. It's the circumstances that matter, which include the interest rates. So best interest duty does not just mean best interest rate. It means the circumstances which include lots of things, features, timing, etc. Peace of mind. Some client might say, I don't give a stuff, just get me the thing approved because I want to go and bid or whatever the case may be. And that's where you guys fit in. Just in finally, just go through, ask the three of you quickly. Are there any changing trends in the borrowing market? I mean, because I think I've been hearing from the team that people with super funds the self-managed super funds are starting to use their self-managed super fund to borrow money to buy property in the fund. What are you guys seeing out there? Changing trends?
Yeah.
Not just I don't want to limit it to super funds, but are any changes in trends? Are people buying more property in state or what's going on?
So a couple of things I'm seeing. Obviously, with the self-managed super fund piece, when borrowing capacity is maximised outside of super in your normal circumstances, Australians love property as a vehicle to grow wealth. So using their superannuation, the contributions that they receive, as well as the rental income from a property, can go to the bank and say, okay, great, I can buy a residential or commercial property within my super fund. I think particularly for business owners as well, it's a really powerful tool if they want to buy a business premise or something along those lines.
Buy it in the super fund.
in
In
their
other words,
super
not
fund.
in their name.
No,
So
within
this is
the
an
trust.
emerging trend. It's been around for a long time, but it's becoming more popular.
It's growing,
You're
absolutely.
seeing more of this.
Yeah, lots more of it. Yeah.
Effie?
Same with me. I've got customers at the moment that can't buy in their personal names, and they're a lot older, and now they're all using the self-managed super fund as the option to buy, and it's more common now because it gives them opportunity to buy interstate in areas that they can afford, and it'll be self-sufficient.
Yeah, the rent will cover the interest.
Exactly. So it'll help them own a piece of Australian property and, still live comfortably and not have the pressure of trying to buy one for themselves, and they'll just continue to rent.
Okay, and are you seeing anything emerging through your branch?
Yeah. Look, similar to Tom and F, self-managed super fund, it's an untapped. When I say untapped, it's starting to be tapped. But we have so many trillions of dollars just sitting in self-managed super fund across the country, right? That's.
Do you know where the second largest superannuation fund Australia is in the world? There's only one other country in the world has more money in superannuation than Australia. We're nowhere near the second largest country in the world. I think we're like, we're a very small country, but we're the second largest, bigger than Japan, bigger than the UK, bigger than any country in Europe, bigger than any other country in South America, bigger than Canada. They're all bigger countries than us. So it's not surprising.
Yeah.
You're many trillions.
There's so many trillions.
Yeah.
I think Australians now are want to make their own decisions. Obviously, there's volatility in the share market. We've seen that happen several times over the last couple of decades. And as I think we've got an aging population now, and people don't want to jeopardize their retirement funds, having a crash just before they're about to retire. So they're opting to utilize these funds to go into bricks and mortar
Because they know it.
They know it.
Yeah.
It's safe, and you can see it, and you can sell it and be in control of it rather than be in some cyberspace in a portfolio somewhere that someone that
Australians
doesn't
love
know what they're doing is managing your retirement essentially. So we're seeing a lot of new super fund lending coming in. One thing I'm going to take this time to say as well is people that got into self-managed super funds early on, right, last 5-10 years, a lot has changed since then. I have been seeing, and if I don't see 1 or 2 a week, right, I'd be lying, of people coming in wanting to refinance their super fund loans. Their interest rates are sometimes in the double digits.
So they
10%.
borrowed before at really high rates.
Correct.
And what they don't realise, they can now get it much cheaper.
Much cheaper.
Into their super fund.
Absolutely. So we have seen clients with interest rates at 9s, 10s, 11s, 12%. Because the only risk with super funds is, when I say risk, it's one of those set and forget type things, right? You don't really look at it like you look at your home loan every single day as, and you monitor it because it's not coming out of your pocket, so to speak, out of your cash flow. Your super fund contributions that your employer pays, they pay for it, and then the rental pays for it. So you sort of just leave it there and you don't review it. Reality is, if those people that have been in a super fund loan, I would say for more than 3 years,
Paying too much.
they're paying too much. So you should absolutely get in touch with a broker
And get it refinanced.
And the interest rates,
They've come down a lot.
they've come down dramatically.
The banks have stepped out of that space. Sorry,
Yeah.
the banks have, like the majors used to offer these loans, and they've fully pulled out of it. So if you're stuck with a major bank with an SMSF loan, the way that they get rid of you is they just constantly increase your rate till it gets to a point where it's
'Cause they don't want to do this
because they
stuff.
don't want the business anymore. So
Okay.
then there's all these raft of new non-bank lenders who've come on board who do it really well
And who want the business.
who are hungry for
and
it.
they'll price it cheap.
And they'll price it.
And that's a good point, Mel. Like refinancing self-managed super fund loans that are probably more than 3 or 4 years. And I just want to finish on this one last thing. You know, the point you made about Australians liking property. It probably does really well in Australia for a whole lot of complicated reasons. You know, the least of which is lack of supply, which we're all well aware of. But the thing about buying property in self-managed super funds as opposed to shares or equities is that you can get leverage. So, you know, for every $200,000 you might be able to buy something for $800,000. You might be able to borrow $600,000. Which means, but if you're buying shares, you got 200,000. You just buy 200,000.
Yep.
You're not buying 800,000. So you can leverage the lenders to get a better return, and the lenders just want their interest rate back. They're not interested in the growth, the capital growth of the asset. No. They just say, just pay me interest. Yep. And if the rent is close to it, or your contributions help, that your employees putting in there help to pay that interest, that's fine. But you own the capital growth off the back of their money, which is, I'm not giving financial advice. None of us are giving financial advice here, but it's a reason why people are flocking to these things.
And also, I think the increases that we've had in the super guarantee contributions over the last few years, like we're now at what, the 12%? 12%, right? Not so long ago, it was 9%.
Yeah.
Now, you buy a $500,000 property in your super fund and you get, let's say, 4% return, right? Let's say your interest rate is 6.5%. Then you've got 12% of your income also going into that. So serviceability is rarely an issue. Do you know what I mean? So it's a really easy, and this is for anyone, self-employed, PAYG. If you've got money in super, serviceability is 99% of the time not going to be an issue, right? So if it's something you're thinking about doing, I would say now's a good time. And super contributions are only going to keep going up, right?
No, I think it's stop at 12.
Did it stop at 12?
It stopped at 12, yeah.
Okay.
Thank God.
Okay, good.
Because I'm an employer.
so am I.
No. But they started off at 8, they've gone to 12, and 12 is the max. Yep. But you don't know, this government could actually change. They could actually increase the superannuation contributions. But the 12% is 12% of your wages. So if your wage goes up, that's 12%. It should be going up. So on the assumption wages go up, then your 12% contribution goes up every year. Guys, I want to thank you very much for this. It's been great. We could talk for hours, but unfortunately, people who look on the various social medias don't listen for hours. Concentration spans not that great. But we may resume this again in the new year. But this is for just to close the 2025 year off. I thought it was a good idea just to talk about what's going on, what's trending out there. How lenders are behaving and in relation to the behaviour of consumers or borrowers, what you're seeing in your various areas and what you're seeing across Australia. And maybe we'll do another one of these in the beginning of next year, just as once your feet hit the ground and you start to see a little bit of trending in for 2026. We might do another one just to see how 2026 is faring and how people should be looking at their borrowing and their asset buying. But thanks very much, Mel, Effie, and Tom.
Thanks, Mike.
Thanks, Mark.